Look, so thanks for joining us today, everybody. We've got an exciting webinar. We're going to be talking about leveraging VPP value for solar and batteries. And it's a big topic. There's lots to discuss, which is why we've got some guests on today. We've got VPP partners joining us and Cornwall Insight, so we can unpack all things virtual power plant and market forecasting. So my name's Tyler Jackman. I'm the head of sales here at Orkestra. Today, I'm just going to run through the agenda very, very quickly. Like I said, we've got a lot to get through, so I'm not going to take up too much of the time. I'd like to hand over to the experts. But we've got understanding the mechanics of electricity markets and VPPs. So VPP partners are going to discuss that side for about 15 minutes. And then I'm going to hand over to Cornwall Insights, who are going to give us a market briefing and a bit of a chat about future forecasts, specifically for the Australian market. And then after we've discussed all that, Tim Johnson is going to come on and give us a demonstration within Orkestra of how we would model up a project with virtual power plants, with batteries, and how you would turn that into a really nice feasibility report that you can then send off to customers or clients and start to see these projects coming to fruition from the very, very early stages. And then at the end, we're going to have some time for Q&A. We're going to keep things pretty tight with time. If we don't get to all the questions today, don't worry. We'll be able to send them on to either of the, any of the guest speakers that they're directed to. If you could just do one thing for me is please, in the Q&A tab down the bottom, there's a chat and a Q&A. Please leave the questions in the Q&A. And please just put, if you're directing the question to either Thomas or Mark or Charles or Tim, please just put their name at the start so I can direct those when the time is right. So before we get into this, I'd just like to acknowledge the traditional custodians of the land in which we gather today. I pay my respects to elders past, present, and future. So I'm going to introduce all of our guest speakers today. So we've got Charles Cattermole and Mark Netto, who are the co-founders of VPP Partners. And we have Thomas Fitzsimons, who's our senior modeler at Cornwall Insight, based in Spain, but he's in the country at the moment. So we thought we'd lock him down while he's on our time zone. And we've also got our own Tim Johnson, our enterprise success lead here at Orkestra. For those of you that don't know what Orkestra is a feasibility modeling platform. We model commercial solar and battery projects, and we do it in a very fast, easy, and accurate way. And really today, we're going to explore about what that looks like to unpack projects and model those in as virtual power plants in our platform. We do have a 21-day free trial for any of you that haven't used our platform before. Please jump in and have a look. We'd love to speak to you. So that's it from me. I'm going to hand over to our first speaker, Mark Netto, who's going to give us all things virtual power plant. Over to you, Mark.
Thank you, Tyler. So good morning, everyone, and thank you for joining us today. As the first speaker, my role is really to set the scene and to give you an overview on VPPs. But before I do that, let me quickly introduce myself. I'm Mark Netto, as Tyler's mentioned, and we have Charles Cattermole, who's joining us today. He won't be speaking, but he'll be supporting to answer any questions. If you've got any questions, shoot them through, and he'll get to them in the chat. So let me first of all introduce VPP Partners. We're a boutique consulting firm specializing in all things distributed energy. So whether you call it DER, CER, or VPP, we can help you. Our clients typically are energy retailers, distribution networks, investors, and new market entrants. And we support them with everything from mergers and acquisitions, product design and implementation, technical and engineering support, and pretty much anything you need to get a product or a project up and running in this space. So that's us. Now, what we'll be covering today is an extract of a full day workshop that we usually do for our clients. So I've compressed, essentially information that we'd give to you over a full day into 15 minutes. So it might be quite light in terms of the explanations, but feel free to contact us afterwards if you have any other questions. We will cover a quick introduction to the NEM. We'll understand what the customer problem is, which is essentially why we need VPPs. We'll have a quick look at the different value streams you can access through a VPP. We will look at the opportunity as well, and then technology and capabilities. So if we could move on to the next slide, please, Tyler. Introduction to the NEM. So the Australian energy system actually consists of 3 markets, in case you weren't aware. Western Australia's got its own market. Northern Territory has got an interim market. But for today's webinar, we're going to focus purely on the NEM, which essentially delivers 82% of the electricity to people within these 5 states. Now, the NEM is a gross pooled electricity market. And the 5 states essentially trade energy between each other. Now, each state has got its own regional price. So the price for each state is different. And there are very, very different market dynamics for each state. So from the CNI perspective, if you're designing for CNI solar batteries, you should really think of each state individually and not assume that how a project might work in one state is translatable into one of the other states. Now, to bring that to life, if you have a look at the table at the bottom right-hand corner, and you look at each of those states, there are 13 distribution networks within the NEM, and each of those distribution networks has got multiple CNI tariffs. So when you're designing projects, it's important to understand that you need to select the right tariff, otherwise your numbers aren't going to make sense. Fortunately, and Tim might show you this later, Orkestra has got all of the tariffs embedded in their software, so you can use that, and that's going to save you a lot of trouble. Now, going on to the next slide, we've got 3 closely linked markets within the NEM, and these are markets within markets, but there's 3 of them. The futures market looks at your long-term market exposure, or is used to manage your long-term market exposure. You may have heard of people talking about buying caps or swaps from the ASX. That's essentially this market that they're referring to. Again, it is for managing long-term exposure. The spot market is essentially the real-time buying and selling of electricity on a price that is set every 5 minutes. So that's your real-time trading of electricity. So when you hear about batteries trading in the wholesale market, this is happening within the spot market. The last market is the ancillary market. You might have heard of FCAS. FCAS is one of the components within the ancillary market. The ancillary market is essentially a balancing market that is used to maintain the electricity grid at 50 hertz, right? And FCAS is a really, really important thing to talk about. So my next slide looks at what is FCAS. FCAS is essential for getting your business case to stack up if you're looking at CNI batteries, right? It's one of the components that everybody is talking about. But it's important to understand FCAS is really a mechanism to maintain the frequency of the grid. It consists of 2 separate types of FCAS: regulation FCAS and contingency FCAS. Now, regulation FCAS, which is not relevant to the CNI market at the moment, it could be in the future, but it's not at the moment, is essentially where large-scale assets are constantly adjusting their generation output to regulate the frequency of the grid. Now, contingency FCAS, which is the other type, this is the one that's relevant to all of you. That's really a mechanism to manage sudden imbalances. So if you have all of a sudden demand increasing or all of a sudden demand dropping significantly, that's where this market comes in to manage the frequency. There are 8, let me get my numbers right. There are 8 contingency markets. There's very fast raise and lower, fast raise and lower, slow raise and lower, and delayed raise and lower. So each of these markets, if you've got the capacity within a battery, you need to bid into each of these markets individually. Now, FCAS is a very attractive market to a lot of people because it's paid out based on availability. Now what that means is you're getting paid for the capacity that you have available and you will get paid as long as that capacity is bid into the market. So you're getting paid for when the battery is not called, as opposed to when it's getting called. So it's like an insurance product. And as long as you're available, you're going to get paid. Now, as you can imagine, for batteries, this is really, really attractive because batteries can do both raise and lower. They can raise the frequency and they can lower the frequency by charging or discharging. And as long as you have the capacity available, you're going to get paid. Extremely attractive, but a few points to note. If you have bid the capacity into the market and the capacity is not actually available, there are liabilities, right? So there is upside, but there's also significant downside, and you've got to think about this, especially when you're aggregating multiple batteries and bidding a portfolio into the market. So just something to think about on FCAS. Now, if we go to the next slide, I just wanted to quickly touch on the customer problem and why we need why we need VPPs. So as you probably know, I mean, I'm probably preaching to the choir here, but we're going through an energy transition. There are four main drivers for this energy transition: decarbonization, decentralization, digitization, and democratization. And what that means for Australia is, in Australia, we've already changed the greenhouse gas emission targets from 2005 to 2030. We're aiming to reduce it by a further 43%. And we're also aiming to hit net zero by 2050. All of the ASX companies are starting to commit to net zero targets. More than 50% of them have already done so, and there's a lot more that are planning to. We also have the government aiming to achieve 82% renewables by 2030. And something that's quite important is investors. More and more investors in this day and age are starting to focus their investments on climate-oriented transactions, right? So the investors are looking for these types of projects. Governments are doing it. The ASX companies are doing it. And as a country, we've got targets that we need to meet, which means that for CNI customers, if we go to the next slide, please, Tyler, there's a lot of pressure on them for them to then try and achieve net zero. And in order for them to do it, it's not as simple as, and I do know the obvious choice is to put in solar and a battery, but it's not as simple as just putting in solar and a battery. In order to get to net zero, you're going to need more than that. You're going to need other projects or aspects on your site working together in order to get to net zero. So you might need a solar, you might need the battery, you might have to look at demand response. You could look at various certificates, energy efficiency, and optimizing your HVAC. These are all factors that you need to bring in together. And collectively, if you can orchestrate all of these multiple assets behind the meter, you're more likely to hit net zero. And that's why we need VPPs. So moving on, now that we know why we need VPPs, let's look at how a VPP generates value. Well, there are 6 main value streams. The self-consumption, demand management are the 2 main value streams that you get behind the meter. So what self-consumption is essentially using the solar that's generated behind the meter and using a battery to maximize how much solar you use behind the meter. Demand management, that's reducing the amount of demand and therefore saving on network charges. Cost to serve is something that is only accessible by a retailer, but cost to serve is where the retailer reduces the cost of the energy that they are selling to you. And then you've got the wholesale market, which we've mentioned, trading on the wholesale market. You've got the FCAS program that I've already mentioned. And there are other programs like RERT and network support that you could also use to derive value. So 6 value streams, pretty easy for you to access some of those values, but you must remember that the natural owners for each of those value streams are not necessarily the same. In some cases, it's the customer. In other cases, it's a retailer. And sometimes it's the network provider. Now, in terms of how much value a VPP can generate, we've pulled some numbers that are publicly available. Please note that these are FCAS only numbers because VPPs are behind the meter and therefore we don't have access to all of the other value streams. But from a FCAS perspective, if you just have a look at this number, Energy Locals has got 2 VPPs. One of them has made about $779,000 from FCAS in the last 12 months. The other one has made $1.1 million in the last 12 months. I won't go through all of them. Have a look at the slides when you send them out. I'm just really conscious we're short of time, so I will keep moving through this quite quickly. Now, what is a VPP? A VPP, as defined by ARENA, is a group of resources that are coordinated using software and communications technology to deliver what is traditionally performed by a conventional power plant. So if we go to the next slide, you can see on the left here, you've got your traditional generation, either a solar PV plant, utility scale, or a coal-fired power plant. They will be historically delivering energy into the power grid, and at the same time exchanging data and cash with the energy market. In the same sense, if you look to the right of the screen, you could have multiple flexible assets coming together. Individually, these assets are small, but collectively, they could be the size of a large power plant, coming together using technology, also delivering energy two-way this time to the grid, so delivering or receiving energy from the grid, and then exchanging money and data with the grid. So it is a group of assets coming together and operating in the same way as a conventional power plant. Now, what's really important to note is you need a lot of capabilities in order to achieve this. So if you look at this from a site perspective, you've got a standard site. If you have a look at the diagram on the left, there's a load behind the meter. That load has got a solar system and a battery system, potentially with an on-market child meter behind that load. Now, for a project like this, if it was a solar and battery PPA, you would have 4 project stakeholders: the customer side, the asset developer, the market participant or aggregator, and the project financier or lease provider. You would only be able to access, as part of your revenue model, 4 revenue streams, which would be self-consumption, demand management, wholesale revenue, and FCAS. Now, in order to achieve this, there's a whole suite of capabilities that you require. You will need a VPP platform or multiple VPP platforms. You will need a system integrator, a metering provider. You may need to do some network engineering. You'll probably need a forward curve, which is what the guys from Cornwall will talk to you about. And you will definitely need a product to sell to the customer. Now, on this last slide here, we've got the VPP stack. This is just a quick reminder for you. It's a bit of a checklist on all of the things that you need to think about as you pull together your VPP. At the bottom of the list, you've got your assets, the aggregation software, and the products and offers, typically what people think about when they are building a VPP. But don't forget, you also need market integrations, the relevant licenses, and to ensure you've got the compliance mechanisms in place. You will need contracts with the various parties, and you will also need to manage the financial flows, so not just the physical flows, but the financial flows. And last but not least, you should have trading, forecasting, and settlements. Now, I've raced through this because there's a lot of information. As I said, we've condensed a one-day workshop into 15 minutes. So as the last slide to close off, I just want to show you what a full one-day workshop would look like. It is really a full intensive day where we cover everything about the market, everything about products. We look at various technologies and the partners that you need. We will help our clients assess their current state and where they need to be. And then we'll build out a roadmap on what you need to do next. So really simple. I know I've raced through this, but I'm going to stop there and see if there were any questions from the audience.
Thanks, Mark. Great presentation. what we'll do is we'll handle questions at the end of the preso. But what I'm going to do is roll straight into Cornwall Insight. So thank you very much. Very insightful, and I think is a very good segue into the next conversation. So I'm going to introduce, today we've got Thomas Fitzsimons, a senior modeler at Cornwall Insight. I've also got Stefano Boscaglia up here on the screen as well, because he's the regional lead for Australia, if anyone's looking to get in contact with Cornwall after this webinar. So I'm going to keep rolling and hand over to you, Thomas.
Thanks very much, Tyler, and thanks, Mark, for laying the groundwork for me there. So I'm Thomas Fitzsimons, a senior modeler from Cornwall Insight, as Tyler's just mentioned. If you're thinking that I sound like someone who doesn't necessarily spend a lot of time in Australia, you'd be correct. So it's great to be joining you live from Melbourne this morning to talk about market forecasting, which is a lot of what we do at Cornwall. So just a brief word on who we are, if you haven't heard of us before. Cornwall Insight was set up almost 20 years ago now in Norwich in the UK, where we have our main base of operations to this day. We have a footprint across Europe, in Ireland, and also here, of course, in Australia. The different services that we offer, we've broken down on the next slide. So most of the work that we do is divided into analysis, the kind of analysis that I'll be talking about today in the various markets in which we operate, as well as bespoke consultancy, building on the foundation of that work, and in many cases, training and introductions to energy markets and how they work. Then I've also given you a very high-level view in the next section of the various market forecasts that we provide. So, of course, I look after the NEM benchmark power curve, which is our wholesale price forecast all the way out to the 2050s. But we provide similar services in GB in Ireland, as of this year in Japan, and will shortly be launching a benchmark power curve in Germany as well. So now on to why you should care about market forecasts. And I think the first thing to highlight is that the general tenet that past behavior is not an indicator of future performance is generally true, and particularly true when we start to look at electricity and energy markets. As Mark has already touched on, the transition that we're seeing in global energy markets, and particularly in the NEM, away from legacy fossil fuel generators to new sources of energy, wind and solar, and often distributed generation assets, is really unprecedented. So there isn't really a historical snapshot that you can find that could be extrapolated forward with any degree of certainty. So I would strongly caution against that approach. Part of that narrative, of course, is that assumptions that we might make today on build out of different technologies, costs of different technologies, the utilization of energy vectors such as hydrogen, whether that's green, i.e. renewable, or from other sources, won't necessarily be true for very long. So at Cornwall, we update our curves every quarter based on the latest information that's available from the industry to reflect those changing dynamics. Taking a more specific NEM view, it's a very interesting market to be operating in, because the market operator, AMO, provides so much of the modeling work that they do to the public. So they really set quite a high watermark for the degree of modeling that's available to market participants. So when they set the bar that high, really everyone who's moving in their space is talking in terms of forward-looking market forecasts, often building on the work that AMO does and shares publicly, which is what we do ourselves as well, often taking the AMO data as a starting point for our own assumptions. And perhaps most importantly, often a forward-looking market forecast is actually a prerequisite to get financing for a project. So if you want to be taken seriously by financing entities, really forecasting is the way to go. And just to touch on part of why the forecasts are so valuable is that they allow us to explore and to some extent quantify the uncertainty around the possible futures that we might see in various markets. So this is a very high level view of how we divide our forecast into 3 different scenarios. This is similar to what AMO do themselves. They provide 3 different scenarios to the market, and we build on those. And you can see here that we're basing our assumptions in different cases on how demand might grow or not grow out into the future, how strict or relaxed emissions reductions targets will be, and also the degree of organization and speed behind new generation build, old generator retirements, and transmission upgrades. So these are some of the factors that we're feeding in to our model and the different scenarios that we pull out. If we take a look now at the NEM in more detail, so this is a snapshot of our Q2 benchmark power curve, some of the headlines from that. So this is a big picture view that we've been broadly telling since around Q1 this year. So of course there have been changes around the edges, but the general picture remains more or less the same, which is that out across the forecast horizon to around 2040, we essentially see a 3-phase evolution of prices across the NEM. So here we have a plot of wholesale prices in different NEM states. We also forecast Tasmania, but I've excluded that there for clarity. But essentially the 3 steps that we see is an initial uptick in wholesale prices as old generators come offline and the extensive pipeline of new renewable generators and large-scale hydro projects is delayed. So that lack of supply pushes up prices in the short term towards the end of the decade. Phase 2, then we start to see those delayed projects begin to come online and start picking up the slack, which does bring prices down into the 2030s. And this reduction in price then suppresses appetite for new generators to come onto the grid. So we start to see prices rise again in phase 3 out towards 2040. If we take a look then at another headline from our Q2 release, and this is an example of the kind of work we do drilling down into specific announcements which might come up from quarter to quarter, and a very good example of why it's worth updating a forecast on a regular basis. One of the key developments between our Q1 and Q2 releases this year was that the expected closure date of Eraring, which is the largest single power station in the NEM, it's a legacy coal generator in New South Wales. That was expected to close next year, but actually the state government announced an agreement with Origin Energy, the owner of the power station, to extend that plant's life by 2 years and potentially up to 4, depending on how further discussions pan out. So here we can see the result of that decision on the power prices in New South Wales specifically. We also see that impact on the NEM more broadly. To illustrate this, we've just zoomed in on New South Wales, and you can see that, as you'd expect, the result is a suppression of wholesale power prices within that state as long as Eraring continues to operate. And of course, the key interdependency there is the transition from Eraring to some of the large-scale hydro projects which are planned in New South Wales, particularly Snowy 2.0, which is already extensively delayed. So that's an example of the kind of developments that we're keeping track of here at Cornwall. If we now take a quick look at FCAS, so as Mark's already mentioned, that's another key market to keep an eye on here in the NEM. Of course, we forecast not only wholesale energy prices, but also the various FCAS markets and other relevant markets in the various jurisdictions in which we provide analysis. So FCAS is a key one for us here in the NEM, and we provide these forecasts also on a quarterly basis. So we'll have our Q3 FCAS report available over the coming weeks, for example, for our subscribers. In general terms, for the FCAS, sorry, Tyler, just to drill down a bit on those numbers. So with a number of different markets available for the FCAS, essentially depending on the speed of response, which is available from the different assets, all the way from regulation, which is the most sustained, down to very fast, which is the charts that I've shown here, the 1 second response for raise and lower. And generally within the contingency markets, so those higher speed response markets, which would typically be used if something unexpected happens in the market, like a large generator or a large load tripping and disconnecting from the system. The faster response markets are more valuable. So the 1 second market is worth more than the 5 second market, which is worth more than the 60 second market, etc. The general trend across the horizon, as you can see, is a gradual decrease in that value, essentially as more batteries, which are primarily the assets which are operating in this market, come online and they're able to satisfy the technical requirements for these response services. And this is essentially due to the fact that the FCAS market itself is much smaller than the wholesale market. So NEM energy demand is typically of the order of up to 20,000 to 30,000 megawatts, whereas FCAS, you're only catering to around 500 megawatts of demand, so 2 orders of magnitude smaller. And as batteries get larger and a single asset is able to satisfy an increasing proportion of that demand, prices start to come down over time. But as I said, more detail, of course, available in our full FCAS report, which we update every quarter. And now just to summarize some of the opportunities available for ESCOs and battery installers more specifically. So here I've taken a snapshot of one of AEMO's key publications. This is their Integrated System Plan, or ISP. And on the left, we have AEMO's optimal build out of various technologies out to 2050. So this isn't necessarily a forecast, but more of an ideal view from AEMO of what they would like to happen. And you can see, of course, here that there's a huge amount of renewable capacity coming online in terms of wind and solar, both at rooftop and utility scale across the horizon. But also that there is a small uptick in dispatchable capacity, which is below the bold black line. And really here, the big story, I would say, is the purple wedge, which you can see, which is the coordinated CER storage, so consumer energy resources, which would be domestic or commercial batteries, or potentially intelligent EVs, which are coordinated at scale, as Mark has already explained. And so I think it's important to keep in mind that, particularly if you're following the energy market, you'll see lots of headlines about big batteries and large transmission connected projects, and they'll often take up a lot of the oxygen. But actually there's a big story to tell on these smaller scale assets, which you shouldn't forget will actually play a significant role in balancing this increasing renewable capacity on the network out to 2050. So demand, both demand and generation, which can be flexed and also differs from the norm. So you start to skip evening peaks or morning peaks, or be able to flex at interesting times of day, will actually be quite valuable to the system as a whole. So lots of exciting developments coming for small scale batteries and solar. So I hope that's given you a snapshot of what we do at Cornwall. Again, it's been kind of a whistle-stop tour. As Tyler mentioned, both myself and Stefano are available to answer any questions later on in Q&A and also, of course, after the session. So I think I'll hand over now to Tim, who's going to step through how you might use forecasts such as ours within Orkestra's platform.
Yeah, perfect. Thanks for the wrap there, Thomas, and really interesting information. And I think it ties nicely into what are VPP mechanics and how do they operate, and then why forecasting is so important for setting these projects up. So Tim, I'm going to hand over to you to share your screen, and we're going to demonstrate now what that looks like in Orkestra. So what it looks like when we put interval data into Orkestra and set those forecasts up, and then what are the different stakeholders in a virtual power plant, and how that all looks of basically building a feasibility report out of all that information. So over to you, Tim.
Thanks, Tyler. I just need you to stop sharing your screen and I'll jump in. There we go. Thank you. Can you see my screen?
Yes.
Great. Okay, thanks, guys. Fantastic presentation so far. So as Tyler says, I'm going to show you in a practical sense how we can do this using the Orkestra platform. I'm aware that we've got quite a number of people on the call who have never used Orkestra, so I'll try and provide some context as we go along, as well as showing you how some of the more detailed elements will occur. So for those who've never been here before, this is the interface of Orkestra, and essentially you create projects which are visible on the map, and then also the more recent ones are right here. So we're going to jump in. I've prepared a demo project with a manufacturer in New South Wales. But before we do that, I want to actually look at another piece, which is our library. So as we've discussed a few times, Orkestra's made a very deliberate decision not to natively provide forward curves in pricing in a range of different areas. So we're not forecasters because we can rely on partners we've heard from who do a brilliant job of that. And so as a default, we'll use historical data, and certainly that's valuable for modeling. But as Thomas said, if you want to be able to secure financial support for some of these projects, you will need to get some forward curves, which are more taking into consideration more factors. So this is the library. It contains a number of different things. So just quickly, when you're creating a project, it's nice to have network tariffs. They get updated annually, and we put them all in so that you don't have to type them in. Same with some retail tariffs. We've also got load profiles. So by default, you will add the interval data appropriate to the site. But if you don't have that, you can actually look at our load of profiles. And there's other pieces here as well. I'm just going to click into the wholesale prices. And you can see here a nice list of different data sets of wholesale prices. And thank you to the very generous guys at Cornwall Insight. They have shared with me 3 of these. They've given me the low, neutral, and high scenarios for wholesale pricing going out to 2042. And I've uploaded them in just by clicking this Add New button and then drag that across to there very simply. So, and then down here, you can see where we've got 1 year historical data. So a few things about this is, first of all, when you look at each one of these, what's nice is you can get a quick idea of some basic parameters around the data, like the average price and what percentage of intervals are over $300 and things like that. So you can see that these 3 vary quite a bit in terms of the high points and the average price. Also, the nice thing is that you can, as with everything in Orkestra, you can visualize, so you can confirm things visually quite often. So if I scroll down a bit, I've chosen this high price data set. I've got pricing from 2024 right through to 2042. And I can see the daily profile here. And I can also see an annual breakdown of what's expected there. So I can get a quick visual of what it looks like. And also on the right here, I can see as I click through to 2025, I can see average price, daytime price, etc. So it's a nice way to just quickly check your data set and make sure it's the one you want to use. So So that's the historical stuff there. You can also change those columns if you want to see other things. Okay, so that's data has been loaded. Okay, so I'm going to jump into this project here, which I've prepared. And for anyone who subscribes to Orkestra, it comes with some default projects, which are great for playing with. And first, I'll just give a little bit of context in terms of what we're looking at. So this is it's in Bathurst, New South Wales. This particular site is a manufacturer. I haven't set an import or an export limit, which I might do importantly otherwise, but in this case, I just haven't. The energy, I can just click into this. As I say, it's very easy to upload your interval data, and you can then also scale that. So basically, you can either adjust the power or the energy if you need to. And similarly, as before, you can scroll down and see exactly what's going on. So you can interrogate that by days of the week or season. You can see the average or the peak, and also you can see an annual distribution there. As well as that, you throw in the tariffs. And so you've got a retail tariff and a network tariff. As I say, you should be able to just look up the network tariff that's appropriate. And if you scroll down, you get a nice display. So based on the energy profile you've put in and based on the pricing you've put in, you can see exactly what a year of charge is going to look like in the current scenario. So in that, up till now, we've created what we call the baseline scenario. This is what's currently existing on the site. And on top of that, we're going to model several, potentially hundreds of different scenarios, which we can communicate with the client until we get a decision on what they want to do. So the motto here at Orkestra is feasibility first. So we're going to check the feasibility by looking at potentially hundreds of different scenarios and then move forward from there, really before we even start designing a single solar system or sizing a battery. So just a few things here then. So we can create multiple scenarios in Orkestra. So in this case, I've created a scenario with a number of different solar PV sizes, which is 7 different systems, and a number of batteries. And so it's going to look at each of those 7 against each of these 5, and it's currently looking at 350 solutions. And so we'll look at that more in a moment. So within each of these, I'll just look at this high one first. I can nominate which forecast data I want to use. So that includes things like emissions, CPI, inflation, other escalators. But relevant here is the data sets. And so you can see here, I've chosen the high data set here with the CPI escalator on it. And that's what I'm using in this particular scenario. So these other scenarios are the same, except for I've also put for comparison a behind the meter stack just to see how that measures up. So particularly when putting this in, when we're looking at VPPs, we need to set up the battery so that it's ready to be modeled in this way. So first of all, we'll choose a battery technology in a range of sizes. But in here, we have the control profile. So this is where we're instructing the system how to model the behavior of the battery, because it's got many different options it can choose from as it goes through time. So here we can toggle on and off a number of different variables. And I won't go into these in detail because it gets fantastically detailed. Also, just in summary, you can choose to use an optimization process whereby the algorithms will optimize based on the usage and pricing. But you can also use a rule-based. So it's more of an if-then series of instructions if you feel like you want to put more granularity on it. So the example there would be, if the price goes to this point, then do this. But otherwise, optimization is a very effective method. And so for each of these, we can look at deploying the battery so that it generates these multiple different value streams. So we've got peak demand reduction by default, and not actually listed here. It's going to maximize for solar consumption. So it's going to, by default, it'll try and displace as much grid consumption as possible. But here we've gone for what we call the full value stack. So we're looking at peak demand, plus we're looking at energy arbitrage from the tariff, which is essentially where you store it when it's cheap and use it when it's expensive. And then these last two are the market exposed elements. So you've got the energy arbitrage, which is going to be using those forward price curves we've got. And you've got contingency FCAS, which we've talked about. So just to quickly look at this, This is the case. This is here where you would say, yes, I want to participate in both the raise and lower markets, and I want to participate in all of the different speeds. Just quickly, because I know this question will come up, we will be adding the very fast element to this, so the fourth layer in the near future. Essentially, we're waiting for a full year of data to come through before we added that. And as it's the most valuable, as Thomas just pointed out, that will be significant. So that's coming soon. We also can set things like bid factor, which relates to how much of your battery you're going to be making available, and also the predictability or accuracy of the data that you're going to be using as you perceive it. This is very much something that anyone would be encouraged to talk to a partner about, because in registering a battery for FCAS, the entire calling is automated, and so AEMO goes through a robust testing process, and you need to make sure that you've got the right capacity available. It is possible to negotiate for different levels of capacity to be bid. Again, I won't go into those details now because it's all fun stuff. Just to finish off, it is also possible in certain environments to also have a backup power and say, please reserve a certain amount of battery. And you may also want to limit the number of battery cycles if that's a concern. But essentially, lots of stuff to set up there, and you may well want to do this in consultation with your partners. I'll just move down the bottom here. Once we've set up really the pricing and the variables here. So you can see that because, as we've just seen, because we need to set up a child meter to facilitate this, we will add a child meter here, and we're just going to set that to take the wholesale pass-through rate because it's exposed to the live market prices, which we've got forecast for. So we've got to make sure that's turned on. If you forget to turn that on, it will come up with an alert anyway, and we're not going to do battery replacement, so we're okay there. So that's how I apply that forecast data and how I set up the battery. So the model now understands exactly how I want to model these things. So what I can now do is typically I would click run, and that's where the computer very, very quickly runs through the many different scenarios, up to 250 different solutions. I'll just quickly mention that if you're doing preliminary modeling, you might want to click on the quick run mode because it is faster, typically less than a minute, way less than a minute, and it simulates the first year. But if we've got a lovely data set such as we do, then you would click the precision mode, and that's going to take a little bit longer, but it's going to incorporate all of that lovely data that we've got in there. You also here just quickly need to negotiate with your client what when they're looking at cash flows into the future, how many years into the future do they want to look, and what's the discount rate, and that applies to the NPV and things like that. But once we've set up the scenarios like that, we can now see how they rank. So I hit rerun before, so you guys don't have to sit through it. And here we've got our results, solution results section. So don't worry about it being out of date. It typically is very conservative, and it will pop up with that if you log out and log back in again. So just to orientate you here, the way that Orkestra displays is it gives you this lovely ranking chart, and each of these blue bars is a different system. So for example, this one is a 488 kilowatt hour battery with 1300 kilowatt of solar, and it's got an NPV of 2.5 million. And so it's calculated using all the different cash flows that are available for the 15 years that it's looking forward. It's calculated and ranked for each of these different scenarios. Now, I could rank them in different ways. I might say, what's the upfront cost? What's the annual earnings, which is a proxy for first year savings? What's the payback period? What's the rate of return? Solar export might be important if you want to make sure you're minimizing exports. And if someone is really interested in grid independence, then you might want to rank by grid independence. But as a general rule, net present value is a great metric because it's a tool used by financiers to compare investments like for like by discounting the internal rate of return on future cash flows. Certainly worth understanding that if you're talking to the CFOs of companies. Now, for each one of these, I can see, if I scroll down a bit, I can see the core metrics for each one. So in this case, I've chosen the one with the best net present value, and it's telling me the upfront costs, the annual earnings, the payback period, the rate of return, the net present value, the solar export, and the energy independence. And it will do that even if as I flick through these, I can see them, which is great. I can compare very quickly what's going on with all these different scenarios. Now, in this particular scenario, in this case, we've actually got 4 different scenarios that we want to compare head to head. So what we do is we actually click here and we're going to say, let's compare all those 4 scenarios, and it puts them into, expands them out. Now, for ease of analysis, I'm actually going to go in and say, give me color coding for those 4 different scenarios. So you can see now I've got them coded in different colors. And what I've done before we started was I've gone ahead, I might just zoom in a little bit there. I've actually gone ahead and said, show me, you can see that I can add a little purple star if I want to remember which bar I'm looking at. I just do that by hitting this button down here, save. And I've indicated the starred, the highest MPV scenario for each of these scenarios. And so from this situation, you can very simply see the range in MPV between them. So you can see it's quite significant. As an example, this case, which is using the high price data set, it has a 2.88 MPV. Moving down here to the low and then further down. So you can instantly see, and you can obviously evaluate those if you click on them, and you can compare across all these metrics at the bottom. That's very powerful stuff for looking at things. So now we've got some further options to dive a little bit deeper. Let's go for this one here, which is, we're going to be conservative, and we're going to say which is the best option in Cornwall's with the low pricing data set. So we click on that, and then we're going to go through to view analysis. So now that we've selected which scenario we wanted, we're going to dive into a lot of data about that. So this is our results page, and there's a huge amount of information here, which is great. And so I'll just jump to give you an example, a bit of a taster. This earnings breakdown pie chart, donut chart, is the sort of thing you can see. And what's really interesting up front is we can see, okay, at the moment with this, we're looking at about 6% of earnings being generated by FCAS, and we're looking at about 6% being generated from energy arbitrage, wholesale arbitrage. So that tells you instantly where the money's coming from, which is great. And you can see that broken down month by month over here. One of my favorite charts is the side-by-side, the head-to-head bill calculations. So this particularly resonates with clients who are trying to get their head around, okay, where's the savings coming from? This is a line by line. So you can see on the left is their current bill, and then on the right is the modeled new bill. So in this particular case, you can see that they've gone from an annual bill of $516,000 to an annual profit of $36,890. You can nominate there to either look at the just the full table, or you can just click to show the savings. So you can identify quickly where they're coming from and where the cash flows are coming from. Again, I could dive into that for a long time. I'll move on. But suffice to say, just quickly, this is a fantastic page for sharing with your client. You can fully brand it. You can actually change the theme colors just quickly if you want to, and you can share a link with, you can create a link and share it with the client and talk to them over a screen share like this, and actually go through in real time comparing multiple different scenarios. You can also export lots and lots of data from this. You can look at the cash flows, the interval data. So if you want to, if someone wants to see a full cash flow analysis, you can send that through to them for analysis as well. The last thing here is, if subscribing, you can actually create your own custom proposal, and it will pull all this data from here and be fully populated in a PowerPoint document or a Word document that you've completely designed yourself, which is lovely, lovely. Obviously, you can drop down here to see the various solutions. So I've got my saved solutions here, and you can compare them very, very quickly. Okay, one last thing I'm going to run you through, which is the good stuff. So we've chosen this particular scenario. Now we want to get into the finances. So far, everything is based on a basic CapEx model. It hasn't really talked about the different money flows. So we're going to click on Apply Business Model. And this is our wonderful business model builder. So for those of you who have worked in large, deeply confusing spreadsheets for hundreds of hours, this will be your best friend. That's what I used to do, and I find this page, this area particularly useful. So again, I won't go into a lot of detail, but I'll give you the overview. You can choose different scenarios that you want to, or templates that you want to use. So you may want to model a PPA, you may want to model a debt finance, or various things. Obviously, you can use templates provided, or you can save your own. But in this case, we're going to use, I started with the battery aggregator one, and I've created one here called VPP Webinar. As we say, I've chosen the low, here we are, the low scenario. And what I've done is I've said, first of all, articulate who are the stakeholders. So I'm not talking about the customer's financing of this and how they might set up a lease. We're really just talking about, that's very easy to do, but I haven't focused on that here. We're really just talking about the customer and the battery aggregator or their partner. And none of these numbers should be taken as recommendations or as fact. This is just simply some modeling that I've done. But what it lets you do is look at key variables like what share of the wholesale revenue is going to go to the customer, what share of FCAS is going to go to the customer, and how much money is the battery aggregator going to make in the first year. And this can be set to just fixed numbers, or in fact, you can set this up to have you can float them. So you can say, set a range of numbers and let it tell me what is the best rate that's going to keep everybody happy. Just to look quickly, the sorts of setup here I've got is customer pays all upfront costs. Wholesale arbitrage is 70%, that's from above. There's a management fee of $1,000 a year. So these various elements can be added and deleted. And then with those in place, once you click goal find, it will then come up and say, yes, we've got based on those parameters, we've got a deal that is going to work for all the parties involved. So this is where it gets really cool. I can come over here and look at the outcomes based on the different stakeholders. So if I click on the customer view, first of all, it gives me that nice summary as it did before. So this particular scenario is a 6-year payback, and we've got net cash flow in year one of $500,000. You've got an internal rate of return of nearly 17%. And then I can see in the blue line is the cumulative cash flows, and in the bars, I've got the individual year cash flows. And I can see a summary of those cash flows, or I can see a detailed breakdown. So while I'm still in the tool, I can actually drag across and see what's happening across those 15 years. If I want to either confirm what's happening or understand better what details. As I say, you can export all this so that you can see it in more detail, but it's nice to be able to see it all here. Now, this is also can be, if I click on View Analysis, this will show me essentially what we saw before, but this time it's now got additional information that is useful for the customer if you want to be able to talk about the financing. Again, this can be branded, this can be shared, and I can look at all the different variables. Any of these charts can be hidden if you don't think they're relevant or you don't want to see them. Also, I can click here and download all the assumptions in a nice list, which is great. And so I'll just go back to the business model. As I say, this can be compared with all the different scenarios that you've started. So you might say, well, that's good for the low scenario. What does it look like for the high scenario? And it will quickly be able to show you, okay, this is what it would look like. So your customer's internal rate of return has gone up to 17.77% with that. So really great for customers' conversations in real time. You've prepared everything, but in real time, you can say, would you prefer this or prefer that? And you can check what their tolerances would be and see if it still makes sense to move forward with a deal. So I'm sure there'll be lots of questions. I look forward to helping everyone understand and get the most out of the tool. But that is a quick summary of how we can model VPPs and understand the value for all parties involved. Tyler, back to you.
Brilliant. Thanks for that, Tim. And thanks to everybody that's spoken today and given demonstrations. What I'm going to do is just open up to some questions. There's been some coming through. Thomas, you've been very active on there. So you've been chatting away and answering as we go. But I just want to bring up some that you've answered. I think it would be great for other people to hear them, what you've actually answered in here. So a really great one from Jamie about the FCAS revenue and I guess the predictions on those markets dropping. And I see you've answered that in here, but like, what are the opportunities if FCAS revenue is going to be decreasing over the next 5 to 10 years? Like, what are the biggest opportunities there for people looking at battery projects now?
Yeah, absolutely. Thanks, Tyler. Yeah, so I've gone through. I've answered most of these. There's a question here from Lachlan, which I particularly like, so I'll pick up on that. Yeah, but for Jamie's question, yeah, right to highlight the decrease in FCAS revenues, and really what we see in terms of the wholesale pricing is that there is increasing value out across the horizon for battery storage to facilitate arbitrage of new renewables. So that's really where a lot of the value for the system is going to be in these new assets. As I've mentioned in my answer, we have another product, our storage profitability benchmark curve, which actually gets into the details of how various different types of storage assets can play in the market and where the revenue will come from in each case. So please do get in touch with Stefano or myself if you'd like to find out more about that. And we might even be able to share a teaser or two from a previous release of that.
Excellent. And I think, while we're on that subject, I think there's another very good question that came through from Lachlan. So I see you've answered that, but basically, like, how are we modeling black swan events, or how are we accounting for them, knowing that they're going to be like huge drivers and opportunities from a revenue perspective, but also, very unique events?
Yep, exactly. And it's a very good question because, of course, in our central forecast, or BPC to be precise, we try and capture a kind of generic sense of volatility. So we do input variability of meteorology and hence output from wind and solar assets, and we couple that with the various scenarios around transmission build and generator build, and combining that with the system constraints that we input into the model, you do get a reflection of a broad brush picture of the volatility across the horizon. The specific question on black swan events is a great question because, of course, in a forecast of this nature, it's impossible to say here in 2029 in September we have a bushfire or a flood or some extreme event which is impossible to predict with that degree of certainty. So again, we have if you like, a companion forecast to the BPC, which is our probabilistic volatility curve, another 3-letter acronym for you, where essentially we break down the possible black swan events that we might see in a given year. So that includes specific outages on the network, various generators, various substations, floods, fires, and we empower the client to visualize the impact of those events and to superimpose them on the BPC. So you can then experiment with potential revenues in the event of one of these black swan events. So it's a great question. It's very important to keep in mind, and we've separated it out from our standard BPC approach because of the nature of these events. But we do try and facilitate conversations around that by exploring that in our PVC.
Yeah, fantastic. Here's a good one. I think this is probably for either Mark or Charles could probably answer this one, but here's a good question about, is it actually possible to earn both behind the meter and in front of the meter for batteries, small batteries, in VPPs? And then you answer that one, and then I'm going to hand it over to Tim to answer the final part of that question, which is that modelled in Orkestra?
Awesome. No, thank you. Can I just add one thing to what Thomas was saying? Just to the other thing to consider is to his answer. You also need to consider the funding model of your project and investors' risk appetites. So one of the things to note with FCAS is because there's no forward contract market for it or ability to contract, it's very hard to get stabilised or fixed returns. It's near impossible. Unlike energy, where you can secure offtake agreements or other types of contracts, which can provide alternative revenue to or take away some of the variability in merchant revenue. So I think completely agree with what Thomas is saying, but just to take it a step further, you also need to understand how you're funding the project, your investors' expectations and their risk appetite, and then what instruments do you need to use to manage that risk. On the question, definitely can. Just note it as a zero-sum game, and it does depend on the physical configuration of the site. So we often see, the battery might be chasing wholesale revenue or FCAS revenue, and then it reduces the ability to provide demand savings or other abilities back to the site. And there are some nuances around metering and the actual electrical configuration and commercial contracts on top of that. But yeah, definitely can. And for those who are following the AEMC, multi-trading relationships or flexible trading are also becoming a thing, which will potentially accelerate some of this.
Perfect. Thanks, Charles. Appreciate that. I'll probably wrap the second part of that question into another one that we've got come through, which I'm going to pass over to you, Tim. But basically, what that optimization feature in Orkestra, when we choose either optimization or rule-based for setting up battery controls, just a little bit more on how that optimization setting works.
Yeah, okay. Look, it is a complex answer, that one. Essentially, the algorithm, it looks at it has perfect foresight, which means it looks 10 days into the future based on the usage data and the pricing data and everything. And it says, based on these rules of the battery behavior, the battery would be doing these predicted things, and that would generate this predictable revenue. And if you want to, you can jump into there and take more control over that. We've certainly got documentation on that, which I'll send through to you if you'd like a more robust answer. I didn't write the code, so I can't go into a lot more detail. But obviously you're going to need comfort that it's calculating things correctly. But as I say, everything's highly visual, so you can see and check what's going on and confirm suspicions and expectations.
Excellent. Thanks for that, Tim. We've had a good one come through. I can see Thomas is typing away answering the question at the moment, but I'll just put it out there live. So, do Cornwall forecasts? Basically, do you compare your results or your forecasting versus actual results, and where do you get your sort of accuracy gauge on those, Thomas?
Yep, another great question from Steve. And yes, so we do, as part of our internal validation process, we do conduct backcasts of our forecasts, and I'm working on the latest one now. So we don't release those comparisons outside of Cornwall, but that is part of our internal validation check. Yes. And in the case of the NEM, it's comparatively straightforward because there's so much data available for us to benchmark against that we can actually get a pretty good sense of how we compare to the market and where we need to make any adjustments if necessary.
Excellent. So, look, I know we've gone over time today by a little bit, but we still see a lot of people on the call. There's a few more questions here that are coming through, but I just want to, first of all, thank all of our guests. So Mark and Charles from VPP Partners and Thomas from Cornwall Insight. It's been a great demonstration today about, I guess, everything that's involved in, what is a VPP and how do we set that up. I have contact details here for everyone. So you can see, you can reach out to Mark and Charles at VPP Partners if you have more questions. Like they said, they run one-day workshops. Thank you, Mark, for trying to compress that into 15 minutes today. It was a lot to get through, but there's a lot in there and you want to unpack that over time. And then as most of the questions coming through, you can see from a forecasting perspective, there's a lot of questions about how these are set up and why they're important to get funding for projects when we're talking about virtual power plants. So please reach out to Stefano or Thomas from Cornwall Insight. For everybody that's joined today, thank you so much. We're going to be sharing the slide deck with everybody and also a recording to the webinar. And then please reach out to us, Orkestra, VPP Partners, Cornwall Insights in the future. We look forward to working with you all. And thanks to all the guests today. Thanks for joining us, and we'll see you all next time. Thanks, everybody.
Thanks all.
Thanks, guys.
See you later. Bye.